Welcome back, options traders. Well, another good question for the group. Why are losses so hard to recover? And I wanted to do this because I hear traders a lot that always want to venture outside of, let's say, the S&P 500 or the QQQs, the Nasdaq 100, to pick individual stocks hoping to outperform the index. And there's certainly nothing wrong with that. Just understand it's really hard to do, which is why your professional money managers are all measured against the S&P 500. But when people do this, when they buy stocks outside of the S&P 500 or smaller baskets of ETFs and it goes against them, they say, well, I'll wait for it to come back. It's still a better performing fund. It's got lots of volatility, and I can always wait to get back to my purchase price. I'm still better off than being in, let's say, the S&P 500. But what they don't realize, there's a real mathematical force at work that is making these losses so hard to recover. So what is that? Well, let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So first off, let's talk a little bit about losses. Whenever you are faced with losses, especially from an individual stock or a small ETF, you must consider the opportunity cost of getting those losses back. In other words, what if you had invested in the SPY or the S&P 500 instead? Because it's not just about making up the losses that you have in your current investment, you must make up for the opportunity cost as well. Because if that S&P 500, let's say, is continuing to rise and you're continuing to just flounder and go flat, technically that break-even point is getting further and further away from you. So it really magnifies the amount of returns that you actually need to get your money back. So for example, let's do that. Let's take a look at the SPY right here. So the SPY are these candles right here, and these are the 5 key moving averages that we've talked about before. But down here, this green line is the ARK fund, ARKK. And I'm not really picking on the ARK fund, it's just a subset of tech stocks. So most of these are going to be in the Nasdaq 100 or in the SPY as well. So again, you're taking a subset of this bigger index trying to outperform the bigger index. You're trying to select a few cards from a huge deck of cards that are going to be the best performers. So take a look at this. Now the ARK fund during COVID, let's see if we can back up here a little bit. So you can see that coming out of COVID, here's 2020, it was just on fire. Everybody was talking about the ARK fund and how it was the latest, greatest thing. Everybody was investing in it. And it was, until it wasn't. And you can see that it quickly fell. A lot of these tech stocks started falling out of favor. And so here's the point. Let's say that after this time frame, you can see that the ARK fund was down 58%. Now that might not seem like such a big deal if the entire market is down that much, but take a look at the SPY. The SPY was up 23%. So not only do you have to make up this 58% loss, but you would also have to get to this plus 23% for the SPY. But it gets even worse, because as time goes by, the SPY is most likely increasing as well. And so not only are you having to make up these losses plus the level of the SPY, but it's a moving target. And that's the thing that traders don't understand, just how hard it is to make up these losses. So let's go take a look at an Excel spreadsheet and find out more of the details. So here's an Excel spreadsheet that I put together, and a number of things that you can change here. I'm going to compare two investments. So investment number one, let's say, is the S&P 500. Investment number two is the one that you chose, a single stock, or maybe in this example, the ARK fund. And so you're just going to put in two different values. Now, typically I would just leave this top one at 100. So you can think of that as it's 100%. And let's say that investment number two is a percentage of that. So if investment number two is down 20%, we would make that 80. If investment number two is down 60%, we would make that 40, and so on. So just for starters, let's say that investment number one is right here For every $100 that you put into it, it's worth 100 right now. But investment number two, for every 100 that you put into it, it's now trading for 80. Now, another thing we can do is to change the expected rate of return for this first investment. Again, let's just say that it's the S&P 500. Historically, it's somewhere around 8 to 10% per year. So as I said, not only do you need to make up right here at the starting point this 20% deficit, but as time goes on, the SPY is now increasing at 8%. So it's moving as well. So it's like being behind a car that you're trying to catch up to, but that car is accelerating as well. And so it's becoming harder to catch up to. And that's the part that traders overlook. So here we have investment number one at 8% after the first year, it's worth $108. After the second year, you get 8% plus 8% on 108, so it would be worth $116.64. After the third year, it would grow to almost 126 and so on. So we have 20 years going out this way. Now, what about the fund that fell 20% that's trading for 80 bucks? Well, if you're trying to get it up to 108, in other words, we were now wishing that we hadn't picked this stock or this mutual fund or ETF, and we had instead bought the SPY, we would need to make 35% just in that first year. So see, it's not just the 25%. You don't need to make up the 20 bucks on a base of 80. You need to make up the 20 bucks on this 100 that's also rising at 8%. So watch what happens after the second year. Again, if you had invested, let's say, in the S&P 500, it would be worth 116.64, or an increase of 1.46 times. However, in order to do that in this fund that has now fallen, you would need 20.7, or about 21% per year for 2 years, keeping in mind that the index, the broad-based market, is increasing at 8%. So that's still 2.5 times as fast. Is that really what you should expect? After 3 years, our $100 investment has grown to almost 126. That's an increase of 1.57 times. Well, to do that on this $80 investment, that works out to be about 16.3% per year for 3 years. And you would now recoup not only your loss, but the opportunity cost of having not invested in the S&P 500. Now remember, 16.3% is still double what our index is assumed to be doing. So the point, now that you understand this spreadsheet, you can see that as you go out in time, that the rate that you need is decreasing. And that's what we've charted down here in this graph. So you need a whole lot, need really big returns in the first few years. And then it will start to level out. Now, why is that? Why are we starting to converge on 8%? Well, remember, that's a feature of compounding. The longer that things compound, that the interest on interest becomes bigger than the interest on principal. So yeah, you're down 20% here, but it's only 20 bucks. And so once that 20 bucks is made up, which is going to, it's a fixed cost, think of it that way, then you're going to start mirroring the rate of return, or the required rate, on the SPY to keep up. But look at this, even after 20 years to make up for this loss right here, you would need 9.2% every single year without fail for 20 straight years, when the overall market's only increasing at 8%. So you can see that it becomes a really tough finish line to catch, especially if you think, well, let me just hold it for another year or two and hopefully I can get my money back. It's a really hard thing to do. Now, I've also changed it to where I can change this starting number. So if I want to make this 21, count out the next 20 years, we're going from 21 to 40. You can see we're starting to close in on 8%. But let's go back up here, looking at 1 through 20. Let's say that the index, we'll keep this at 8%, but let's say that your first investment falls 40%. So this number would actually be 60. What happens now? Look at this. You would need an 80% return in the first year, not only to make up this loss, but also for the 8% rate that the SPY is increasing. After 2 years, you would need 39.4% per year for 2 straight years, 28% for 3 straight years, 23%. Look at this down here, 20% for 5 straight years when the overall market's only increasing at 8%. You have to say that is just so unlikely to happen. Now, another thing to consider is, which we've talked about in previous videos about the effect of volatility, but let's say that you get a 20% increase in the first year, that's multiplying your money by 1.2, but then let's say you take a 10% loss. So that would just be 0.9. You've retained 90% of your money. Well, look what happens if we take that times that. You're at 8%, which is exactly what the market's doing. So even though you might get lucky for 1 year to be 20%, if they're mixed in with 10% losses, it's going to knock you right back down to the rate of return of the SPY. And again, that's another way to show why that is so hard to beat. It just takes a small handful of losses, and not even necessarily big ones, to knock that rate of return way down. So I did that just to kind of show that you might look at this and say, oh, I think I can do 18% for 6 straight years. Fat chance of that happening, because that would be 17.6 per year every single year without fail for 6 straight years. You slip in one 10% fall, or something even less than 17%. Let it be 12%, plus another year that has a 10% fall, and those averages are going to get chopped severely. So I thought that was just something interesting to look at. I've talked about it before, but I think a lot of traders overlook it, especially when they try to buy things like the ARK fund, and they end up finding out that they're down 40 or 50, 60%. And they look at the rates of return and they say, well, it's doing 15%. It's still better than the S&P. Let me just hang on to it and I'll eventually get my money back. It's moving at a faster rate, so it's still the better investment. And what they overlook is that S&P is also increasing. It's moving away from you. That opportunity cost keeps growing every single year. So does this mean that it's wrong to venture outside of the S&P 500 or the NASDAQ 100? Of course not. That's what investing and trading is all about. I still think that the S&P and QQQ, other broad-based indexes, should be the core or the anchor of your portfolio, but there's nothing wrong with some occasional speculation on individual stocks. But this is where the options really shine, because now you can customize your risk-reward profiles so that you never end up in this type of a situation. And so successful investing isn't about picking the right funds. Everybody's going to pick some duds. What matters is how you manage the risk for the times that things go against you. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.